Welcome back, everyone, to another episode of Ready, Aim, Retire. As usual, I'm Rob Kirvan, your host. The show where we'll talk about anything that touches retirement planning, whether that's income planning, investments, social security planning, legacy planning. We do a lot of. As usual, today I'm here with Tony Shore. Tony, how we doing?
I'm doing great today, Rob.
Yeah.
Thanks for asking, and thank you for having me on your show. It's been a fantastic week for me, although I'm a little disappointed in the teams that are in the Super Bowl this year. I'm not too excited. We're going to talk football.
Right. A little football there. I like
Yeah,
that. For
little
those watching at
football.
home.
So, are you going to watch the Super Bowl? I'm
Yeah.
debating even watching it. You
I'm
will?
definitely
Okay.
gonna watch it. So
Okay.
I'm probably like you. I don't know who you wanted, but I would have preferred Buffalo being in. I feel
Yes.
bad for them. It's like you keep getting to the dance and you just keep getting turned away. Now,
Yeah.
as being a sports fan in general, and I don't have, I'm a Chicago Bears fan, so I don't have to worry about like these situations because they don't come up ever. And so I am kind of rooting, for something that's never been done before would be Kansas City. I know like I've seen maps where the people in the country like Kansas
Yes.
City, it's just basically Kansas City, but I will be rooting for them because they will do something that's never been done before. So I'd like to say, hey, you know what? I watched Kansas City win the three-peat, never been done before, just like I watched, all the greats. We saw Michael Jordan do a three-peat. We saw Gretzky, his run in hockey. So, hey, you know what? Why not throw that one up there? But I'm with you. I would have preferred to see, I don't mind the Eagles in there. I like Saquon Barkley. I think
Barkley is fantastic.
He's amazing.
I mean, he is amazing. Although
is what I like about him. He's just like a good person too.
Yes, and I've disliked Philadelphia a lot in the past, but mainly because of their fans.
Oh, it's terrible.
And they've been terrible in the past and just known as the worst fans in the league.
Mm-hmm.
So for that reason, I might not root for Philly. But I'll tell you what, I do like some of their players, and Saquon Barkley is one of my favorites. I wish the Vikings would find a way to get him over there. We'd win the Super Bowl if we had Saquon Barkley. I mean,
guy's. I don't know. You say that, but like the Minnesota always finds a way to, like what we get like 14-2 or something.
Yeah.
They've, great regular season squad always. Playoffs just they're not your thing. So whatever. So I wouldn't spend the money. Like you're gonna do great in the regular season.
Yeah, I love the negativity on the Vikings coming from a Bears fan this year. That is super super special.
I would kill for a good regular season team, Tony. Even if you told me we would never get anywhere in the playoffs, that would be very good.
Only 2 teams beat the Vikings this year, even if you include the playoff game. The Rams, and the Lions. That's it.
They might have want to do a little homework before they play them again,
Right. How can we lose to the same team? We lost to the Lions twice. We lost to the Rams twice.
Right. Wow.
Yeah.
All right. Onward and upwards. We'll be watching, though. What do we got? 2 weeks? Not this weekend, next weekend? Yeah, definitely be watching.
Yeah, for sure. All right. So what are we talking about today? We're headed into tax season already, aren't we?
We're getting there, right? Everyone's getting your statements coming in.
Right.
Starting to get some phone calls. It'll kind of heat up. And a lot of our clients, Tony, are retired. So you're kind of like, they're way more, they got more time to be more organized, whereas people when they're working, it isn't even a January conversation. It's more like a March conversation, sometimes April conversation. But they're getting organized and things are getting organized. And what I wanted to do today is go through some of the tax changes for 2025. Because as we get into this year, usually after tax season, we have clients come in that are doing Roth conversions and things like this. And we take a look at the taxes. So we need to know what's changed for this year so we can get it, kind of organized. Because at the end of 2025, folks, the tax laws change. So there'll be new taxes, new laws proposed. I'm going to tell you, Tony, that the current tax law was put in by the current president. So I wouldn't anticipate a lot of changes, but there's a couple I'm going to point out. So we may see some brackets slide and some things like this, and but for the most part, I don't see a lot. But again, we don't have any of the data yet on that. But I'll tell you what is happening right now, so people out there can plan for how they do things this year, especially distribution wise and things like that. So let's start. So The brackets, the actual tax brackets, Tony, all remain the same because they're under the current tax law. The only thing they do though is they push them up a bit because of inflation. So the brackets shift a little bit. The standard deduction has moved up. So a single filer, the standard deduction has moved up to 15,000, and for joint, it's moved up to 30,000. And I'll tell you, for a lot of my clients, that rule went in the last tax plan. And the purpose behind having a higher standard deduction was to get people, less people itemizing. Where
Right,
people
to simplify it and to make the
simplify it.
system flow a little better.
And I believe it does. And I also believe that
I agree. I think that's the best part of that
so much
whole.
easier, right? Like I
Yeah.
still have to do, because I've, some moving parts with, a kid still in college and some other things. But for the most part, most of my clients, they would never have got if they're married, a $30,000 deduction, unless they have a big health year, which we've seen from time to, but they don't. A lot of them, have very low or zero mortgages,
Right.
so they have no interest to write off. They have no dependents, so there's not a lot to write off. So that is a huge benefit. I'm hopeful that they keep that one intact. If anything, that they're
Yes.
going to change, because I think that makes people's lives a lot easier, especially like when if you're single or once you have kids out of the house, hard to scrape up those deductions to itemize to get to 30, quite frankly.
Oh yeah, my wife and I mean, we used to really itemize and work hard, but that standard deduction is been a huge benefit for us.
Right. And especially with the the SALT tax, where it's a maximum of $10,000. So you don't even have to your tax bill, is there, plus your income taxes for the state. So most people are over that anyway. So it's just an easy 10,000. I hope they bring that. I hope they get rid of that though, Tony. I'm going to be honest with you, but
Yeah.
that's like a nice little bonus deduction in there. But regardless, long-term capital gains tax brackets. So this also moved up. So if your taxable income joint, so let's say we're married, if your joint income is under 600,000, your long-term capital gains are 15%. So if you sell a stock, long-term capital gains, you pay 15%, which is the majority of the people. But that moved up a little bit, which is kind of nice. If you're above that, it's 20%. And for you single people out there, that number is 533.4. So if your income is below 533,000, you pay 15%. If it's above that, you pay 20. I'm not going to get into, there's another little thing with a little bonus tax of 3.8%, Tony, depending on income and things like that. We're not going to get really into that today. But the long-term capital gains is a big one, because as that shifts, that 15% shifts, because 5% is big. We have people.
Oh yeah.
They might sell a rental property, where you're paying long-term capital gains on, and 5%, if you have, a $200,000 gain, and it's $10,000. So it's a big deal. They may sell stock, things of that nature. So that's a good one. Social Security, taxable earnings, that increased again. They do this every year, Tony, with inflation. They have to put that in. Obviously, more important over the last 4 years than it's been in a while, but they still push that up. So Social Security tax that you pay and I pay and everybody pays that's working. The new limit is 176,000, which means everything you make up to 176,000, you and your employer each pay 6.2% of your income.
Right.
After that point, you pay nothing. And that goes into the pool of what you'll get down the road. We've done a million Social Security shows. So, but on Social Security, there's Social Security taxation, Tony.
So
This
those
one
are two different things. Social Security
Dude.
tax is what comes out of your paycheck during your working years that goes into Social Security. That's the Social Security tax, and that's 6.2 for the employer plus 6.2 for the employee. So, but taxes on your Social Security income in retirement, that's another one, right?
It's a little different, and it's got a little bit of a wonky formula, and again,
It is.
anyone confused with this, feel free to give us a call. Well, we can run a Social Security maximization to show kind of what you're going to look like as far as that goes. But for a single person, so first of all, here's the formula, Tony. It's taxable income sources, non-taxable interest, plus half of your Social Security. All right. Can everybody repeat that for me, please? Can everyone repeat that for me? Anyways, taxable income sources. So let's say Um, yeah, my IRA distributions, taxable, non-taxable interest, might be bond interest, might be CD interest, might be something like that, or muni bond interest, something like that. And then half of your Social Security benefits. So for single folks out there, if this formula adds up to under 25,000, you pay zero tax on your Social Security. So let me give you an example, Tony. Let's say my Social Security was paying me $20,000, and I was taking out $10,000 from my IRA. So I have $30,000 worth of income, but the formula would take that $20,000 of Social Security, cut that in half. So now it's only 10,000 plus my 10,000 distribution. So I have 20,000. So I'm really getting 30,000, but for this formula to see if I pay tax on my Social Security, it's only going to count as 20. So that would be a zero. Just to make things confusing for everybody out there. I hope you had your pen and papers with you. But anyways, if I can get taxed up to 50% from 25 to 34,000,
right,
and up to 85%, it's a sliding scale, but over that 34,000 mark.
I don't know why they
it's a confusing
calculate
one.
it this way.
I
It's
don't know
the government. It's the IRS. They have to. I mean, they have to
It's just
complicate
bizarre,
things.
isn't it? Isn't it just a weird calculation? What I think they do is they kind of make it just confusing enough that you're like, well, I guess they'll figure out what the tax is on it, because I sure can't figure out what the tax is on this thing.
Right.
Joint people, Tony, same formula, same example. Under 32,000, you pay zero. Up to 50,000 or up to 50% is the bracket of 32 to 44,000, and up to 85% over 44,000. So let's say you're out there, you're married. Your Social Securities together add up to $50,000. I mean, you're taking a required, you're taking a distribution from your IRA, or a part-time job or something that adds up to 10,000. So I got 50,000 Social Security. I divide that in two. That brings me down to 25. And then I got this $10,000 distribution I got to add on. That brings me to 35. So in that case, I would be in the middle bracket, the 32,000 to 44,000. So I'd pay up to 50% on my Social Security is what that would work out to.
So 50% of your Social Security at that point would count as taxable income, is what you're saying.
Yep. Up to 50% of it.
Yeah.
Your other stuff will be taxed as ordinary income, but up to 50% of your Social Security would be taxed.
Yeah. So at least the whole thing is, a lot of people don't realize that any of their Social Security can be taxed. Right. They think, well, it was a tax that I paid in. They're not going to tax that when I get it back. Oh yeah.
And you know what? Some people, Tony, like a lot of people, they just live on their Social Security. So if an average couple, they were both getting their Social Security, and they were getting a total of like 5,000 a month, so $60,000, right? So 2,500 each. Divide that in half. That's 30,000. So they wouldn't be taxed on it because it's under 32,000. So there's a fair amount of people that pay zero tax on it. But you do get into a situation where you down the road, the required distributions, whether you like it or not, they're going to come out. That's definitely going to affect your taxation. That's why a lot of people do, look at that. And when we look at that, sitting down with clients, we look at, all right, how can we avoid some taxation? Part of the taxation, part of the legacy planning, doing Roth conversions and things like that.
Yes.
And this time of year, we usually wait till people are done their taxes, unless they're currently in a plan that we kind of have a good handle on it. And we start doing the Roth conversions, do a little bit, every year. And all of a sudden, 5 years later, you got a lot of Roth over here, a little less IRA here. So your hand's not forced that you have to take these distributions, right? And especially if you don't need the money, and a lot of people don't, a lot of times it just, when we're doing these distributions, it literally goes from their IRA account that we manage to the trust account that we manage. It just shoots down. We pay the taxes on the way through because they actually don't need the money, so all of those kind of play, from a planning standpoint. And it's good for you guys to know out there kind of what your income is going to look like. Next up, Tony, let's talk about the other big tax one I want to talk about today is the gift and estate tax.
Oh,
all right. So these changed also, and again, everybody listening, all of these expire the end of this year. So the current tax code expires the end of this year. We will start getting information over the coming months of what the new framework looks like. what the brackets are going to look like. And the biggest one is going to be what I'm about to talk about. This is where I foresee the biggest changes. When you're talking estates, Tony, and estate taxes, it's much easier to tax somebody when they can't fight back because they're not here anymore. That's the easiest spot to tax somebody. If you're here, you can make an argument. If you're not here, okay. And a lot of people don't think of estate taxes. They kind of do, but they get to the point where it's almost, I don't want to say too late, but they're down the road a little bit before they're like, wait, this might be a problem. Or they're not working with somebody that has knowledge of this kind of stuff, right? So all very, very important. So let's look at the exclusions first. Annual gift tax exclusion has increased to 19,000. It was 18 last year, or 38,000. And what is a gift tax exclusion, Tony? That's the amount that we can give. Like I have 3 daughters. I can give each daughter $19,000 a year. I don't have to report it on my tax return or anywhere. So it's an exclusion. If I get over that, Tony, then I have to report it.
And that means the person you give it to. So if my dad gives me my mom and dad give me $19,000.
Yep.
I don't have to claim that I won't have to pay taxes on it as income.
Nope.
It won't count toward earned income.
It will not. And they would have already paid tax in one, coming from their savings account at one point to pay taxes on. But yeah, as the recipient, no, it's a gift. It's the best one, Tony. Those are the good ones.
Yeah.
Tony, do you know the maximum amount I can gift every year?
How much?
Unlimited, as long as I'm willing to pay the tax.
Oh, yeah.
Yeah. So you can gift. Like I have a lot of clients that just gift because they're trying to get money out of their estate. So they're gifting, it's 19 now, but it was 18 to their kids or whatever. And then I sit with them and say, you can gift more than that. And when you look at when you look at the lifetime exemption, that's kind of what this is bumping up against. A single, it's increased to 13.99 million. All right. So that's a lot. For a couple, it's 27.98 million. You can gift
you
can the amount you can gift to somebody in your lifetime. They're your total gifts in your lifetime.
Oh, okay.
So let's say, for instance, Tony, let's say I have my 3 daughters. So let's say one of them is buying a house and they're like, Dad, can you help me out with the house? And I look at between Natalie and I, we have 38,000 per year we can give. Well, I can give like Megan $100,000 as a gift, and 38 is my exemption, right? So I have 62,000 left. So I have to file what's called a gift tax return. That's just basically a ledger that shows the federal government that I've used part of my 13.99 million. So it comes up. There's 0 taxes paid, 0, because I have an exemption. It's just a matter. People don't understand. It's just one more piece of paper that you just have to file. They have
but if you give your daughter $100,000 for a house,
yep,
does she have to count that or some of that as income and pay taxes on it?
Nope. It's a gift for me. So it goes against my exclusion. I would have already paid taxes on it. So you can't pay taxes. You can't pay it twice. No, people don't realize that you can.
I thought if my dad gave me over a certain amount, it would count toward income for me.
No,
or my mom and dad.
Counts towards your life. Counts towards their lifetime exclusion, not
yours.
You're getting the money, right? But they have this huge lifetime exclusion,
which is millions of dollars.
Yeah, you're at basically 14 million single, 28 million as a married couple, right?
Yeah.
But this all sounds fine and dandy, doesn't it, Tony?
Yeah.
This expires, like I said, at the end of 2025. There's a lot of chatter that it's going to drop down to the $4 to $7 to $8 million range.
Sure.
So again,
unless they just extend the Tax Cuts and Jobs Act that enacted this in the first Trump administration, because Trump's back in, he might just extend the whole Tax Cuts and Jobs Act. But who knows if Congress will do that? Yeah.
Yeah, it still has to go through. But my guess on the taxes is going to be very similar framework to what we deal with now. Like with that standard deduction we talked about earlier, with the brackets, they might shift the brackets a little bit. And we're not going to get into the corporate side, but because our clients are mostly personal. But we may see something on that estate, that exclusion, because that exclusion is so high, it affects a small percentage of everybody, right?
Mm-hmm.
So you might see that come down a little bit because it could be a tax generator, obviously, right? So that's an interesting one, and hopefully I feel you just learned something that
I did.
yeah. So hopefully folks out there, if Tony learned something, he all Tony does is sit with guys like me all day, so he knows a lot. He knows a lot of this stuff. So I'm glad I gave Tony a little bit of something.
Taxes are I'll admit, taxes are my weak area.
Yep.
That's where I'm the weakest. I know a lot about retirement income planning from yourself, and I've learned a lot about Social Security and Medicare and other types of financial planning and investments. But taxes always, I don't know what it is. There's a barrier that comes up. Oh, IRS formulas.
Right.
Chink. The barrier is up.
Is it because maybe they're not so exciting, Tony?
That has a lot to
That's
do with
probably
it.
some of it, right? Some of
Yeah, I'd rather take my own life than talk about taxes,
it.
but here I am.
I
No.
remember accounting in college, Tony. So I
Oh,
remember this one class, and you would have to do like business calculus and all that, and I could kind of get around. The accounting was just like they give you like this one problem, and it would take you like hours because you had to find and you're doing the debits and the credits, and I would sit there and just be like, it was the most monotonous stuff on planet Earth. Like I can understand why people don't get too excited with the tax stuff, but folks, even if you're not excited, if you haven't fallen asleep yet, I got another really good one. So I'm in the state of Illinois, Tony. Most of my clients are. I do have clients all over the country because they've moved, through retirement, be with family, things of this nature. But
I'm in a state of shock. You're in the state of Illinois.
right there you go. Well, ours
Okay.
is kind of shocking when you get to this number. So the state of Illinois currently they're you still have estate taxes. So you have state estate tax. So we just talked about the federal. That's a like a lifetime exemption. But when you pass, each state has its own estate tax. So the state of Illinois, because people get confused over this, there's an exemption point of $4 million. So people get confused and think, okay, up to 4 million, I'm cool. And actually the point of it is if you get a penny over 4 million, Tony, your entire estate is taxed on a sliding scale. So it's not an exemption, it's a breaking point. If you're under there, pay zero tax, right? So if I keep it under $4 million, I pay zero tax. But once I breach it, my entire estate is taxed. And it's a sliding scale. To give you an example, I printed this off to get what that scale looks like. So the first 40,000 on the house. Thank you, the state of Illinois. We appreciate you. Then it goes like 40, the first 4, then the 40 to 90,000, is 1.6%, so on and so forth. So each little piece is taxed all the way up to, what do we got to? Up to 10 million. 10 million, you hit around 16%. But each piece is hit. So, let's say, let me give a bracket here. So my 640 to 840 is 200,000 at roughly 5%. So there's $10,000. So I add that 10,000 to the bracket before, and all of a sudden, if my estate's worth just over 4 million, I have $250,000 to $350,000 in estate taxes.
Yeah.
And people don't, and obviously the higher you go, the bigger the number is, right? So when you're doing planning, you really have to look at this. You really have to look at, all right, where is my stuff? How am I paying the taxes? And you have told me, like, you grew up on a farm. My father-in-law is a huge farmer. His farm is worth millions of dollars. And when he passes, it's all land. You can't slice off a piece to pay the taxes on it, which is probably gonna be multi-million dollar of a tax bill because of the size of this estate. So he ages ago. He's up in Canada, so he's got his own financial guy that helps him out. He got a life insurance policy to pay the taxes.
Yes.
And the reasoning he told me was, and you're from a farm, you can probably relate, but he told me because he didn't want his land fire saled to pay taxes to the government.
Right.
And he wanted people with cooler heads to be able to pay the taxes. And then there's four children, my wife's one of them, to then be able to sit down and decide, what are we going to do? Like, what's the plan with this? Nobody currently works on the farm with him. They all do their own things. So who knows how that settles out, but liquidity in that case, he saw that these taxes were going to need to be paid. And people if we're looking at, a state tax barrier of 4 million, you need to prepare for these taxes to be paid, or your stuff's going to get sold to pay taxes. at maybe not a good time. Like, what if all your stuff was like IRA money? And what if you passed April 1st of 2020, just after COVID, when the market went down 35%, and we have to sell a bunch of your stuff to pay for the estate taxes at the rock bottom, you know? So these are the conversations you need to have with whoever you're working with, have it with us, to find out, hey, we're going to have a tax problem. How do we prepare for it? But those are the
And
go ahead, Tony.
well, and there are strategies. I want to point out to the listeners and viewers that there are strategies to cover those taxes in
Right.
those cases,
Many different.
so you don't lose the family farm or the family business, or you don't leave your loved ones in a huge tax burden situation,
For sure.
like
Even what if
taking
you
out
own
a
a
life
house?
insurance policy to cover it.
Yeah, a life insurance policy is a great way to do it. You know, we have lots of clients that do that. That's it. That's the easiest way because the money gets the people right away. But it could even be like we're talking farms, which, you know, they're big pieces of real estate. But what if I owned, you know, a house, and then what if I had a piece of property in Wisconsin or a lake house? Those are, you know, those are assets I can't sell the bedroom to pay the taxes on. Like, they're hard
Right.
assets. Whatever their value is in your taxable. So you really have to look at your full picture, and all the little things that are going to pile into this $4 million mark to go, okay, we might have a situation here. Let's deal with it. You know,
Yeah, that happened to my grandfather when he passed away, and that's what I had to try to help my dad and his siblings deal with is
like the
de
liquidity.
yeah, well, the va they had a an adjuster or whatever come out, look at the farm, and give, "Okay, this is worth the land and everything. It's worth this amount," and it
Right.
was over the state tax amount. I
Mhm.
think in Minnesota, it's the same. It's 3 or 4 it's 4,000,000, I think.
Okay.
It was over that, so there was a crap ton of taxes, and even though the land didn't go to one person, they divided the land up, and there were 4 siblings, and they each got 80 acres, right?
Okay.
But it didn't matter to they said, "Oh, the state of Minnesota wants this, so you're gonna owe this, you're gonna owe this, you're gonna owe this."
So each of you had to owe it separately.
Well, it would they figured out what each person's share would be, but they
Okay.
said, "You owe the state of Minnesota this much."
Yeah.
But I got involved and said, "No, my dad's not paying $65,000 in taxes because there's no liquid. He has no money and he didn't inherit any money. He
Right.
inherited 80 acres of farmland that my grandfather didn't want to sell and he doesn't want to sell. There is nothing liquid. Plus my dad was living on that farm and
Oh,
his
okay.
land was attached to where he's living. Plus, it
Right.
was homesteaded and been in the family. So it's an active farm. So he got around it as long as he fills out this form every year and sends it into the state of Minnesota. He has
Wow.
not paid any taxes on
Oh,
that land that he inherited.
wow. Good for you, Tony.
Yeah.
Yeah.
So, but each state is different, and the
Yep. It is.
states are when it comes to that, states are worse than the government because, like you said, the government has some high number that you don't really need to worry about with gifts and estate
Right.
tax and
Mhm.
things. It's not as bad, but the states, some of them, like Illinois and Minnesota, are actually probably two of
Yeah. Yeah. They're
the
high.
worst.
Yeah, yeah,
Yeah,
they're high,
yeah.
and the that threshold is so low, like not that 4 million is low.
People think, oh, millionaires, then they deserve it. They should have to pay it. No, you don't understand. Like a family farm, there's no
Right.
liquid. It's not like they have 3 million in cash.
No, and I have clients that inherit like lake properties in Wisconsin, been in their
Yeah,
families for 100 years. So this thing might be worth, you know, $600,000-800,000 that in theory is theirs. They're passing it on to their kids because they want to keep it in. But when they pass, it's kind of on them, and that's adding to their house here in Illinois and whatever. And
yeah.
it
If you
you get
have
that
two
number.
homes, you're inheriting a cabin and maybe some vehicles or other property and a home.
Yeah,
If you die and you have a home and a cabin and you have some in an IRA, a traditional IRA, or money in the stock market, all that adds up pretty quick.
it does. It does quicker than you think, especially when you look forecast. You know, folks, when you're sitting there, think of where you are right now, and let's say you're 70 years old. What does that look like when you're 90?
Yeah.
Real estate goes up, accounts generally go up. And you have to. That's how you have to look at it. Like you have to plan for the worst, Tony, because that Illinois threshold of 4 million, that could be 2 million, that could be a million. We don't know. that can change, just like the federal exemption can change, just as tax laws. And as we live, if we go 20 years or 25 years in retirement, we're going to go through several of these different tax codes. They change every like 4 to 6 years. The states, they change administrations. So you have to plan, like, the current one is really, really good, but maybe that's not what it's going to look like 20 years from now.
True. Well, some great stuff. I'm sure it will elicit some questions from our listeners. Sure. Rob, how can they get a hold of you?
They can get a hold of us 2 ways, Tony. Give us a call direct, 630-780-1099. And feel free. You can come on in. If you're a client, obviously you come on in all the time. So you can come in, book an appointment. If you're not a client, it's complimentary to come and sit down and kind of show your situation. The other way you can do it is just go right to our website, apadvisorsgroup.com. If you're watching, you can see that on the bottom, apadvisorsgroup.com. But if you're listening, go right on there. Host of different materials you can learn from on there. You can also click a box and book an appointment directly right on there. So either one of those, but I think it's a topic, Tony, that taxes are very important. They become more important, I feel, in retirement than they are when you're working, because you're trying to preserve, and you need this money to last your whole life. And what does that look like? But definitely give us a call, folks. Reach out, and we'd be happy to hear from you.
All right. Thanks, Rob. Listeners and viewers, that does it for today's episode of Ready, Aim, Retire with our host, Rob Kirvan.